From today, India's tax system is undergoing one of the biggest reform scenes in past decades. The government has brought a new law, simplified terminology, and all of this is going to affect you daily, your salary, your investment, and your financial activities. Hello everyone, welcome to Vajiram and Ravi's Flash News. My name is Shubhangi Singh, and today we are going to discuss in detail the changes that have been brought in by the new Income Tax Act of 2025, which will be implemented from this new tax year which starts today. So let us begin with understanding that when we are talking about Income Tax Act of 2025 and we are talking about tax reforms, what exactly it is. So when we talk about India, India was monitoring and managing tax law. When we are talking about India, earlier than this, India was following a very old law, which is the Income Tax Act of 1961. Now, this act was brought in last year and it is going to be replacing the Income Tax Act of 1961, and now we will have Income Tax Act of 2025. So think of it as an old app which is being updated to a new version. Now when new version would be there will be certain new features. We will be talking about those new features. One of the biggest structural changes that have been done as of now is to introduce the term tax year. Initially we had terms financial year and then we had assessment year. So when we are talking about financial year, basically the timeline in which you earn, and assessment year was the timeline in which the tax was calculated. Now the term has been brought in tax year so that the earning and paying tax comes together. The whole idea of these structural changes and the new provisions that I will be talking about, the whole idea was to simplify it, because the old laws were way too complex. They were difficult for common people to understand. Furthermore, there were many loopholes which could lead to tax evasion and also too many complicated terms. So this law is trying to simplify that. Furthermore, when we are talking about structural changes, there have been multiple reorganization of the provisions which were given in the act so that there is better clarity, and the whole focus has been on digital compliance, better compliance and more transparency. So the whole law laid in taxation, difficult for common man to be understood, is going to change into a user-friendly taxation so that India comes up better in terms of tax collection, and also it aligns better with the global practices. Because when we are talking about single tax period concept, tax year, that is influenced by the global prevalent practices. Now let us straight up move to understand the provisions across the areas. The first major change in the category we will be talking about, that how has filing, compliance and procedural rules they have changed. So when we are talking about income tax return, filing and the deadline for salaried person has been kept the same, that is 31st July, but for professionals and business and self-employed, that has been made 31st August. That means there has been an extension, because when we are talking about ITR for salaried people is comparatively less complex as compared for professionals. Now next we have the revised return timeline. So when we are filing for returns, there is a possibility of errors. For that, the correction window earlier used to be 9 months. Now it has become whole 12 months. That means up and until March 31st, the revised return can be sent in. So basically it brings in improvement in error correction, and also if a person has made error by chance and they voluntarily want to comply and correct it, it increases and enhances that provision for the person. At the same time, we are also seeing certain changes in terms of TDS simplification, tax deducted at source. When we are talking about TDS being filed, initially there were separate forms which existed for separate incomes. Now what has been done, wherever is your income coming from, be it mutual funds, dividends, your salary, your FD, one single declaration is required across multiple sources. Furthermore, there will be lesser chances of duplication, and the compliance burden on the common man, which finds very difficult to grow go across separate forms, that would be eased out. Apart from that, provision related to NRI, non-resident Indian property transaction, has been also changed, where buyer can deduct TDS and that TDS will be deducted using PAN, permanent account number. Initially it used to be TAN, that is tag deduction and account number. So no TAN will be required the cross-border transaction, because usually PAN is present and it can be deducted, the TDS can be deducted right there. TAN separately or mandatorily is not required anymore. So the cross-border transaction, especially for NRIs, that will be eased out. So what we get to see, the whole idea is to simplify it, bring in less confusion, less paperwork, and bring in a more digital as well as easy system. Apart from that, there are certain important changes for salaried class and household economies, starting with house rent allowance. So when we are talking about house rent allowance, the proofs that were required, that were not very specific, and that was a lot of misuse and tax evasion because of it. Now if you are availing house rent allowance, in that case you have to give the landlord PAN and also a proper rent proof. This is a higher scrutiny that has been brought to ensure that tax evasion cannot be done with fake rent receipts. Furthermore, when we are talking about house rent allowance, it was 50% for metro cities and 40% for non-metro cities. But the problem here was, for metro cities, only 4 cities were included earlier, that is Mumbai, Delhi, Kolkata and Chennai. Now there has been addition to the metro cities, that is Bangalore, Hyderabad, Pune and Ahmedabad. Now metro cities are 8. Earlier they were 4. Now these metro cities are eligible for 50% salary HRA exemption. That means the government is recognizing that yes, there are more metro cities, urbanization is actual real, and these need to be included. That means more people can claim higher tax exemption. Apart from that, there have been certain extra benefits which have been increased. For example, the meal card which was present, that was only for ₹50 tax-free benefit. Now it has been increased to 200. Gifts which were limited to ₹5,000 now increased to 15,000. The children allowance that was allowed, that was only ₹100. Can you imagine, given in the time that we are standing in 2026, that has been increased to 3,000 per month, and hostel to 9,000 per month. That means disposable income will increase, because these are the tax-free benefits that can be availed. Because this will be availed, there will be saving of more tax and more disposable income would be left in hand. Apart from that, there have been some rationalizations that have been done. For example, company car valuation has been increased. That means company car will be now taxed more. If company gives car, slightly higher tax has to be paid, and also the driver cost that is being put, that will remain taxable. So at the same time, when the government is giving us tax-free benefits, government also wants to look into their tax base, and they are going to tax the fringe benefits. So we clearly get to see that yes, government is giving a lot of benefits, but government is also going to check the misuse and also ensure their enhancement of tax base. Now the next category that we are going to talk about is about investors and market and financial behavior, how that is going to be affected. So the first thing that has been changed is about STT, that is Securities Transaction Tax. Now that has been increased. So if you are trading with options and futures, the taxation on that has been increased. Why it has been increased? Because the speculation which leads to volatility in the stock market, that it's to be avoided and that is to be discouraged. Apart from that, buyback taxation. When companies or people buy back their shares at higher price, in that context, earlier it was taxed like dividend, but now it will be taxed like capital gains. That means the holding period, how long you are keeping it, will be considered. Based on that, it will be long-term capital gains or short-term capital gains, and that is why it aligns with equity taxation principle. that you can clearly see that the government is avoiding gambling type of investment. Government wants to encourage long-term investment. So in that context, there have been changes about sovereign gold bonds as well, that tax-free redemption, that is only for primary issuance buyer. That means the first person there the gold bond has been issued to, he will be able to get tax-free redemption. But if there are secondary buyers from the primary issuer, then that would be taxable. That means this is going to promote government issued instruments, at the same time help in tax base increase. Other than that, there has been a direct provision about dividend and mutual funds, that there will be no deduction for interest on borrowed funds. That means if you have borrowed funds and the interest that has been placed, no deduction will be given for the interest there. So the tax arbitrage strategies, that will be prevented from the government's end. So basically the government here is saying that if you are taking loan to invest, and the reason you are investing is because you want to evade taxation, so you can't do that. There can be no reduction of tax using borrowed money. So if you are investing using borrowed money, we will not be giving you any deduction there. So we clearly get to see that the government is promoting long-term investment and also discouraging any shortcut or reducing the tax tricks that can be present. Now moving to the next category, that is about what are going to be changes to the foreign transactions, education and also welfare. So when we are talking about TCS, tax collected at source for foreign travel, earlier it was up to 20%, now it has been put flat 2%. For example, earlier what used to happen, that if your trip is going to cost rupees 5 lakh, earlier only 1 lakh would be blocked, 20%, 5 lakh ka 20%. 5 lakhs 20% is 1 lakh, but now it will be only 10,000. So the cash flow burden, that would be reduced, that would be minimized. Apart from that, if there is any education and medical services going for abroad, that is also reduced to 2%. So the human capital investment, that will be supported, it will increase. And motor accident compensation, the interest on that has been made fully tax free. So this is also welfare orientation that has been pitched. So we clearly get to see this is going to help students, this is going to help the patients, this is going to help the tourists, and also the welfare angle is present as well. Now moving to the last part, there are certain changes about PAN. So PAN reforms have been also brought. So when you apply for PAN permanent account number, initially it was only Aadhaar that was required. Now there are structured changes and Aadhaar only route has been removed. That means there will be a proper structured way through which you can apply for PAN. Apart from that, PAN will be mandatory for high value transaction. If you are making 10 lakh deposits, PAN will be required. If you are buying a property more than rupees 20 lakh, worth more than 20 lakh, PAN will be required. And if you are doing any luxurious spending, that PAN will be required. This will not only improve transparency, traceability, but at the same time this is to ensure that government can trace the money easily. So there is reduction in black money, there is increased tax collection, and more people are brought into the formal economy. Now these were the broad changes that have been done. What are your thoughts on this? Let me know in the comment section. I'm leaving you here with a prelims practice question. Put down your answers in the comment section. I'll be waiting for your answers. That was all. Thank you so much.